Hello everyone, this is chessNwine. You might recognize me from the stock twits and Twitter universe, and recently I've been blogging on ibankcoin.com, as well as my own personal website, doublediptrader.typepad.com. Now what I'd like to show you today is a very long-term chart of the SPY, the S&P 500, and basically if all traders were taking an exam, the minimum requirements, the kind of gimmies to get at least a C, would be to identify this double top right here. This is the top of the NASDAQ.com bubble in the year 2000. This is the top of the credit and housing bubble of 2007. Now, pretty precise double top, especially for a long-term chart. Very precise right there. And as far as the other gimme would be this double bottom right here. Kind of stands out. Both these tops and bottoms pop out of the page at you. Now this double bottom right here, not nearly as precise as this double top. I recognize we went down to 666 or 66 right here. But all things considered, you can see how symmetrical it is. Now the part that has caused the greatest consternation for traders, professional traders, is trying to game this middle area and trade around it. Okay? Now, let's take a look at the previous bear market. We had this bottom in basically 2002, 2003, and then a straight shot up right here into 2004. Only when did we reach the point, okay, of the previous bear market, the last stand of the bulls in the previous bear market, did we get some selling. And this right here, you can see right here, this is multi-quarter selling right here in 2004. The rally took a very long break here. Okay, so you see this symmetry. These were all the longs who got trapped in the previous bear market before the final crash. This is this actually right here is 9/11. Okay, the 9/11 sell-off, and then people who bought that bottom thinking it was the bottom, they got trapped, and then we had the final descent here. And only when they were finally made whole did they sell. Okay, I hope everyone sees that concept. Now, in this particular bear market, it would happen in a much more ferocious way. Okay, so let's take a look at the monthly. It was a much more ferocious, quicker bear market. So really, the point is that the most amount of longs got trapped, basically at 1,300 in the summer of 2008 after the Fannie Mae, Freddie Mac bailouts, right? So the idea is that we could potentially rally back all the way to 130 on the SPY or 1,300 in the S&P before we get some selling. You see, we don't even have any green candles here. They're all red. Okay, so this was the last stop before the selling right here, summer 2008. However, we might not be able to make it up that far. Okay, 1250, 1260. Was an area that was extremely significant during the bear market. This was the SocGen scandal. We found the bottom. This was the Bear Stearns sell-off. We found the bottom. This was the summer 2008. We made a temporary bottom before finally falling off the cliff here. Okay, so the idea is that this level was previous pretty sturdy support for most of 2008 before the crash. Okay, and now the idea is that once we get back up here at 1250, the presumption is that it's going to be extremely tough resistance. So support will turn into resistance. And then we might get a couple quarters of kind of this sideways action right here. So what I would argue is the closer we get to 1250, the more you should be inclined to reduce your long positions. And even if we do make it above 1250, 1300 is going to be a very tough level. So you have to really consider risk versus reward at this point in time. During our nice little bull run here, I would be extremely hesitant to put on some long-term, long positions at this point. So that's kind of the point of my video today. So thanks for listening, and please follow me, and I hope I see you on the web.